Hey everyone, me Kevin here. So something went very wrong. Tesla actually beat expectations, which is incredible. Tesla, on the basis of 12 analysts surveyed by Bloomberg, projected that Tesla would bring deliveries to 223,677. The average projection was 221,952, and that's what Tesla mentioned to investors. So Tesla mentioned 221.9. Analysts expected 223.6. Well, we ended up, folks, with 241,300 cars being delivered in the third quarter. Those are the 3 months, obviously, preceding October, so going backwards, that's September, August, July. What's interesting about those dates is it's in the midst of the supply crisis, the supply chain shortages. In fact, if you have a Tesla that gets into an accident these days, it's very difficult to get new parts for your Tesla because the parts are so needed and in such short supply that they're difficult to come by. It takes a very long time. The parts are probably sitting on a ship somewhere, and a lot of the parts are destined for new vehicles. So how do we fix, or how do we fit, rather, what just happened with Tesla into the future of Tesla, especially at the same time as individuals like Chamath Palihapitiya have suggested that they have completely sold out of Tesla. And now I will say, in fairness, regarding the Chamath thing, it actually turns out that he didn't just sell Tesla. It actually looks like he has not owned Tesla at any point in 2021. So it sounds like he's out of it. He was obviously one of the early investors in Tesla. I've not owned any Tesla since before 2021, he wrote. I was speaking only as an enthusiastic supporter of the company and its mission. Okay, so in other words, he's just sort of reiterating that, hey, I don't own any Tesla. So he paper-handed last year, basically, on Tesla, which is fine because Tesla actually hasn't done so much so far this year. It's kind of been a sideways mover. It's up a little bit, but certainly lagging the S&P 500. But what I want to do is just take a look at our spreadsheet again and forward projections for Tesla. Now, these are obviously bullish estimates here, but the estimates that I'm about to show, we'll go through sort of bear, bull, and base case. We'll go through the cases here in just a moment. But what we're trying to do is we're trying to project out for 2025. And what's very important when it comes to any kind of growth company is recognizing, especially with Tesla, that even though it already seems like their stock price has moved so much, it's always useful to consider what the S-curve of manufacturing looks like. So before we hit the spreadsheet, it's important to remember that the S-curve of manufacturing looks a lot like this. And so hence this kind of sideways looking S. And basically this is where you start off with production at basically zero. You very, very slowly ramp up production, which is hard to do. Lordstown Motors just sold their factory to Foxconn so they can essentially contract manufacture. NIO, which is my second EV position, is a contract, or they contract out their manufacturing to JAC, which is 50% owned by Volkswagen, 50% owned by the Chinese Communist Party. So it's worth noting that manufacturing is very difficult. Sure, the legacy automakers manufacture their own vehicles, but they're also trying to create essentially a brand new S-curve. See, the legacy auto manufacturers, they might be right here with their manufacturing, where they've essentially plateaued with what they're making. That's Tesla, or, Toyota, Ford, GM, right? With them starting anew with EVs, sure, they have experience to get factories up and running and scale, but you wonder how that legacy experience translates over to a new, essentially, product, electric vehicles. A lot should be similar, right? Paint, body, airbags, things like that. So many things should be pretty similar. So you'd think that might give them some competitive advantage, but oftentimes legacy companies are slower to adopt new technologies or adopt new machinery. They're dealing with unions that in some cases might help them advance, but in other cases could hold them back against automation, for example, which is something Tesla doesn't have an issue with. Tesla doesn't have a unionized workforce. But anyway, the S-curve is really essentially this right here. And when you have companies like Lordstown Motors, Fisker, Canoo, Arcimoto, a lot of them get stuck here. And the reason the companies go public is to essentially sell a vision. And hey, if the public gives us the opportunity of raising money, then we can scale our manufacturing and then we can actually get going on the S-curve. So in my opinion, and this is just my opinion, the most difficult part of manufacturing for EVs is this right here, this first inflection point. And Lucid actually is probably somewhere right here. They're at their first inflection point. Now they got billions of dollars, a lot of it coming from Saudi Arabia. And we're able to build a factory in Arizona, and they're rolling out vehicles that people are going to start getting deliveries on within the next 2 to 4 months. Whereas, again, a company like Canoe or Lordstown, they're still at zero. Then you've got the retrofit companies. It's a totally different world, like the XL Fleets or the Hyliion or whatever. I don't even really consider that vehicle manufacturing. That's more like taking a vehicle that's already been manufactured by somebody and then adding an electric drivetrain and calling it an EV, right? Semi-trucks have a lot of space, so you can doink with the systems. I shouldn't say doink with. You can upgrade the systems. But anyway, Tesla, in all realities, even though the Tesla stock price, if we zoom in, and this is always worth noting, even though Tesla's stock price has kind of done this, right? It kind of feels like we've already been on an S-curve, and I'm trying to align these by time. Tesla's manufacturing is still really only, maybe here? I mean, it is really at the beginning of the S-curve. Sure, and if we zoom in on this, it becomes a little bit more apparent. We are well ahead of the competition. Maybe NIO is probably somewhere like over here. You're actually in the manufacturing stages. But if the end goal is for Tesla, let's say, to plateau around what Toyota manufactures, let's say 10 million vehicles per year, then you might be somewhere around the inflection point, the rate of change, you'll probably ramp up pretty heavily to about 5 million vehicles a year. And then you'll start to see this inflect and slow down. And this curve is going to become very important in terms of valuation, because what happens with growth companies is you tend to very, very early on, you have, and I can't even remember if I know how to draw it. There we go. You have an infinite PE ratio with companies when they're early on, because they have negative earnings, right? If you have negative earnings, you essentially have an infinite price to earnings ratio, because your earnings are undefined. But as you get to a NIO right now trades for something like a forward PE ratio of 60. Tesla trades somewhere around a forward PE ratio of closer to 50 right now. This is trying to project forward to 2025, let's say. That's about what, at least in terms of Wall Street estimates, what they trade for. My estimates are a little bit more bullish. See, if I believe, we'll get into the spreadsheet and I'll explain this a little bit better. But the point is, and these are forward PEs, so what I should really do is get to current PEs, because it'll make a little more sense in terms of this chart. Forward PE is really looking at what's the company potentially going to be worth in the future. So NIO's actually still at an infinite PE ratio. I just looked it up on Bloomberg, and Tesla's at about 393. And so what happens is, this is the market essentially pricing in growth. And eventually, when you get to this lower area over here, this is kind of like where your Fords and the GMs are, right? And this is where you're going to be a lot closer to a 10 to 15 times PE ratio. And that's because you're pricing in less growth, because you essentially have less growth. You've plateaued. You're growing at 3 to 4% a year or whatever. This is why when people say, oh, well, that company has a high PE ratio, I'm not interested in buying that because it's overvalued. Or people say, this stock has a 10 PE ratio, that's undervalued. No, they're just at totally different places in the S-curve. And when you're buying a company over here, you're buying into way less growth than you are over here. That's why the market values things like this. But it's worth noting that when you chart an S-curve here, your PE ratio on Tesla is going to decline, right? It's going to get back to normalcy. So I would say you might go 300, 200, 100 over here at 5 mil, because you still have a lot of growth ahead of you. And then as we round the corner over here, you're going to start going to 50 and 25. And you might actually, because there's so much technology involved in Tesla, I would say Tesla probably is going to end like an Apple around a 30. So you might have a whole lot more of a curve that looks something like this. This would be a little bit more appropriate. Who knows? Maybe this is around 7.5 mil. Maybe this is around 10 million vehicles. And there's still some growth to get it to 12 million vehicles. Or Tesla goes bankrupt, right? But this again becomes very, very important because when we look at the spreadsheet, this will all make a whole lot more sense right here. So this is my my old spreadsheet. This is my 2025 essentially base case scenario. We're only going to look at this here really quick. I'm going to keep this nice and simple. So revenue per vehicle, 40,000 might honestly be low. They are monetizing full self-driving very well, and I expect the price of that to go up substantially when full self-driving is actually full self-driving. I was complaining on Twitter the other day that I still have not gotten my opt-in button, and there are a bunch of idiot Twitter trolls who are like, well, you should drive safer. Apparently, these are folks who either don't follow Tesla a lot or they're just trolling, because if you don't have the button to push, they don't actually start monitoring your driving. The way it works is you click the button, then they monitor you for a week, then you get invited to the beta, maybe. But the button isn't even there for me. And it's really annoying because I have the full self-driving computer, I had that upgrade done, I verified with Tesla, I have all of the hardware that I need, even though I don't have the in-cabin camera in my 2008 Tesla. So it's kind of just frustrating that I haven't been able to push the button yet. Like, it's kind of like you go to Disney World and you see a long line. I'm not bitching about the fact that there's a long line. I'm complaining about the fact that I can't even get in the line, right? And I think that was a customer service faux pas by Elon Musk because he said Tesla owners are going to be able to push the button. Well, I'm a Tesla owner and I haven't been able to push the button. So I get a little pissed about that because I just feel like it's misleading. And sure, like I get it's one thing if it's like, hey, we're gonna roll this button out to people over time. Fine, but just be transparent about that. So that just bothers me a little bit. But anyway, so if we go with 40,000 and we assume by 2025 about 4.8 million vehicles, this services and energy doesn't matter so much. In fact, I'll delete this in a moment and you'll see it. That's going to get us about revenues of around $235 billion. We do have expenses here. And now I did not include any semi-revenue, robotaxi revenue, insurance revenue. For the sake of this presentation here, these are all zero. Now, people complain sometimes in the comments, why are you not including this? Well, I'm not including this because it's hard to value and I don't need to. In fact, this is all just bonus. It's just gonna make my estimate look lower, which is good because I still have a bullish estimate. So these are what I call the conservative buffers, where it's like the icing on the cake. Like, hey, if that gives me an extra 5% return annual compounded, like great, I'll take it. But I don't need to estimate this for the purpose of this video. If anything, it's just a safety net for me. So I'm gonna go with a 28% margin on the vehicles that they're selling. And we're gonna take 15% off for operating expenses. And 250 mil for interest. That's about where they've been hanging out. That could fluctuate. That doesn't matter so much. So that's going to bring us to about a $25 billion profit. And we're going to take off a corporate tax rate of about 22%. We do have a risk factor here that taxes could be going up. But anyway, shares outstanding, that would bring us to about $17 in earnings. If we project to a 100 PE ratio in the future, that brings us to about $1757 as a share price. The present value of Tesla has gone up. It's about 780 right now, and it's probably going to be higher on Monday. Maybe it'll cross 800. That means over 5 years, we'd have a compounded annual return of about 17% investing in Tesla, if this ends up being true, which is not bad. Okay, so now obviously we can play with this spreadsheet a little bit. If, for example, I went in here and I said, hey, what if Tesla's revenue per vehicle is higher because maybe they're selling that full self-driving? That's $45,000 per vehicle. That might bring us to $1979. But what I'm actually going to do is I'm going to go ahead and drop my estimate to be a little bit more conservative. And so I'm actually going to just drop this to what if we're only at a 75p in the future? That's 1,300 per share. That's still an almost 15% annual compounded growth rate between now and 2025. So, and that's with a 75 in the future. And again, very, very important to compare this to what you have on the S curve, which is right here. In my opinion, extremely important. And it helps visualizing the PE ratio in the future, because then it gives you a little bit more of an understanding that, okay, so high PE does not necessarily mean overvalued. Now I'm going to make a few more modifications. So the first thing I'm going to do is I'm going to change this 22% tax rate to 26.9, just in case Democrats get their policy through. And you'll see this number change when I hit enter here. That difference is how much that tax increase is worth in share price. So we're going to go from 1757 to about 1647. So that's $110 of a difference if this tax increase goes through. $110 is your punishment just because of a higher corporate tax rate, which would change your compounded annual rate of return right here. Let's see if we go to the 800, or let's say it's $800 on Monday, right? So $800 on Monday, present tax rate, It gets you about a 17% annual compounded. If you got a higher tax rate at 26.9, you would be, oh, yep, let's actually put the little percent sign in there. There we go. So you'd lose about 1.5% in return annually because of that higher tax rate by about 4.9%. Another thing that we can do is we can kill energy here, which is a marginally profitable business. So if I kill this and hit enter, we should see this go down. Yep, okay, so energy business worth about $38 or so. So if I kill the energy business, we lose about $38 here. If I bump the vehicle average selling price, this is where you should see a larger move. So from 1609, if I bump this up, we should, yeah, see it goes to 1812. So it more than makes up the tax increase and the loss of energy, you know, if we wanted to play those sorts of scenarios here. Now, one additional thing that I thought was very interesting is if I go in here and I just take, if I say we make about $2 billion, let's say, or roughly 1% in Robotaxi network, because the Robotaxi network is extremely high margin, which I'm just going to assume it has a 30% expense ratio. So if you bring in about 1.92 billion, you only spend about maybe 570 million in terms of like software, engineering, development, customer service, whatever. A really high ratio of profit, right? That's like 70% profit margin. You could really see, with a lower tax rate, you could really see the stock price move with just a relatively small take rate on robotaxis. And so this is where, because this is so high margin, whereas all of these other items are low margin, like services, you lose money. Because it's not just the 95% operating expenses, but it's all the other operating expenses on top of that. So you're really losing money on services. Right now, you're tentatively losing money on energy, or roughly barely profitable. I expect that to obviously get better in the future. But for something like Robotaxi income, this could have a substantial impact to the bottom line. So for example, if I bump this to 5% here, and we actually make this formulaic here, there we go. Bump this to 5%. Because we're going to be bringing so much to the bottom line, expenses are so little, we could see that share price move dramatically. 5% full self-driving revenue, over about $10 billion of full self-driving revenue, in addition to car revenue per year in 2025, would substantially change the profitability for Tesla, well beyond where we sit now. So that's kind of my belief. This, I would say, you know, 1,300 to 1,700 is pretty reasonable for me by 2025. The thing is, the stock might soar before that. We could end up getting a euphoric rally between now and 2025. Quite frankly, we could have a euphoric rally in EVs at the end of this year. As we get out of the supply chain crisis, we could have a euphoric rally in EVs. And this is why when Cathie Wood says, hey, if we hit $3,000 before 2025, it might be time to sell. She's right, because then the stock would be running way ahead of the fundamentals, which some say has already happened. But hey, given where we are on the S-curve, I think we've got another big rally to go, and I'm very happy about the way deliveries came in. So congratulations to Tesla, congratulations to Tesla shareholders. Monday should be a beautiful day. Thanks so much for watching, folks, and we'll see you in the next one.